Hi, everybody. Thanks for joining me. Before we get started, I'd like to ask you to hit subscribe to my channel to keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen for a message from our sponsor, The Motley Fool, where you can get the 10 best stocks to buy right now. All right, so it's kind of hard to believe, depending on who you ask, it's kind of hard to believe that 2022 is coming to an end. Some people feel like 2022 has taken 12 years to finish, and others think it's just flying by. I'm kind of in the latter camp. And I've done a lot of buying this year, and I know you have too, Tyler. So why don't you tell us the favorite stock that you bought in 2022 and kind of what your reasoning is behind it?
Sure. I'll honestly, I've been a little more measured in my purchases for 2022, mostly because of what I follow and what I like to invest in. But 2022, I would say the company I am most intrigued about its future and most excited about its future right now is Noble Corporation, stock ticker NE. They are an offshore oil rig company. And I know over our long history together, I've tried to convince you about offshore oil rigs and led you astray many a times. But I'm going to try again anyways. The reason I like it right now, I'll keep it short, is in the overall market, the service market in the oil industry is improving. Utilization rates for the total fleet of rigs out there is improving, and it's also leading to higher prices that these companies can negotiate in contracts or day rates. So both of those things working on the grand scale. Going down to the more company specific, this is a company that has re-emerged from Chapter 11 bankruptcy and has no debt on the balance sheet and doesn't have any large foreseeable capital obligations in the near or medium future. So it's not building any new rigs where it has to front a lot of capital to do anything. It's a lot of maintaining existing fleets or maybe reactivating some idled parts of its fleet. With that, so the fleet looks good, and also there's a lot of contract rollover for them, meaning that they're going to be able to capture those new rates as things are being bid at. And absent that debt, it's going to have it's expected to have a relatively high free cash flow yield. Management is projecting anywhere between 11 and 30% over the next 5 years. So there is a lot to like there, and with all that extra cash and no debt, the expectation is going to be that money's going to be going back to shareholders. So what it does in the next year or two, I don't know, but I think the payoff over the 3 to 5 window is going to look really good.
So I think the stock you were referring to that I bought was Transocean. That's kind of the one that turned me off from offshore drillers. So my immediate reaction, as someone who doesn't know that much about the space, is what's the difference between investing in this and when I invested erroneously in Transocean a few years ago?
Sure. So we are now in a constructive oil market. Back then, we had a lot of supply of not only just capital expenditures were declining, but we had all these extra rigs. And in the past 5 years, the fleet of rigs that are available globally has been cut almost in half. And so there's much fewer amount of rigs that are being asked for or are available for actual contracts. And at the same time, now after 7 years of underinvestment, we are starting to see a pickup in activity for exploration drilling. So with the combined extra demand coming in and the drastically reduced fleet, it's going to be a more profitable time. And as I mentioned, a lot of these companies have come out of bankruptcy with very clean balance sheets. So excess cash is actually going to be able to go somewhere rather than just servicing debt loads.
Yeah, it's been a while, but I don't think Transocean's debt was zero when I invested in it.
Still isn't. They were the only one that didn't go bankrupt. So they still have their debt overhang, which was good for the business surviving. But putting new money in today as an investor doesn't look as attractive as some of these cleaner balance sheet companies.
Makes a lot of sense. Mine's a company that doesn't need quite as much of an introduction, Amazon. It's one that I thought I kind of missed the boat on, especially in 2020 and 2021. I was the guy who called Amazon expensive back in 2012. I thought I completely missed the boat during the COVID pandemic when it really just pulled forward a lot of growth and shot up to new record highs. It was almost a $2 trillion company at one point. Amazon's about 50% down from the highs. A lot of people don't realize that. They're about 50% down from the highs, and Amazon, as soon as it dipped below $90 a share, that was kind of my point where I was like, okay, I have to add this to my portfolio. It's really rare to find a company that has two dominant businesses. They have about a 40% share of e-commerce in the U.S., which e-commerce is only about 15% of retail, so that side has a lot to grow. They also have about a 34% share of the cloud infrastructure market through AWS. And to put it in perspective, the number two company has about 20%. So a big market lead there. That market itself is expected to roughly quadruple in size by 2030. So that could be a big win for the company just by maintaining their market share. And that's by far the higher margin of the two revenue sources. And that doesn't even kind of mention any other industries that Amazon could and probably will get a foothold in, healthcare being one that they're trying to kind of figure out where they fit in there. But there are a few other, and they operate some brick and mortar retail. They own Whole Foods, and that could just be the start of something big there too. So it's a company that I think it's historically been a mistake to bet against, and I've decided to stop doing that essentially.
It's a fun hypothetical question, and this is kind of what has always made me very hesitant isn't the right word, but just curious about it. If tomorrow Amazon announced a split and said we're going to split off AWS and everything else into two separate businesses, would you want to invest in both of them separately, or is there one where you're just like, yeah, I want to go here, this other business without the other doesn't seem as attractive?
I mean, it would depend on the details of their plan for them, for sure. But, I mean, I would have to think that AWS would have a higher valuation right now, especially, price to sales, things like that. It would have a much higher valuation. I mean, without AWS, it's essentially Walmart in terms of profit margin. So that's a very good question. I like that they have those two dominant businesses, but there is that overhang, they call it a breakup big tech and things like that, that could eventually cause Amazon to do that. So that's definitely a good point. One to think about a little more. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.